Charlie Munger, The Complete Investor Book Summary and Key Points. If you are actively involved in investing or are just getting started in investing, the chances are that you will have heard of Charlie Munger. At almost 100 years old, Charlie Munger is an American billionaire businessman and investor. He is known as Warren Buffett's right-hand man and is the vice chairman of Berkshire Hathaway, the company Warren Buffett took over in 1965. Warren and Charlie have used this company to make investments averaging a return of 20% per year, and through Berkshire Hathaway, they own substantial stakes in the financial service company American Express, technology giant IBM, and beverage giant Coca-Cola, as well as many others. Charlie Munger has also served as the chairman of Wesco Financial Corporation from 1984 through 2011, and he is also the chairman of the Daily Journal Corporation based in Los Angeles, California, and is also the director of Costco Wholesale Corporation. So you can see from his career that Charlie knows what he is doing with regards to business and investment. But before we get into the key points and summary of The Complete Investor, please hit that subscribe button and comment, "I subscribe" below, so I know who is serious about improving their financial education. Done? Thanks. The book The Complete Investor is written by Trent Griffin and offers a large amount of insight into Charlie Munger's quotes, comments, and strategies around investing. Some of these quotes you have probably heard before if you have been in the investment industry a while. Quotes such as, "Successful investors must possess an interest in the process. It's no different from carpentry, gardening, or parenting. If money management is not enjoyable, then a lousy job inevitably results. And unfortunately, most people enjoy finance about as much as they do root canal work." And, "Three things ruin people: drugs, liquor, and leverage." And, "Too much competency and no gumption is no good." And there is also, "When good management is brought into a fundamentally bad business, it's the reputation of the business that remains intact." One of the first lessons the book advocates is that you treat your stock as an ownership stake in a business. When you buy a company's stock, you are buying a piece of that business. You own a small portion of it. If you think about your stocks and shares in this way, you will have a lot more respect for them than if you just treat them as another stock symbol in your portfolio. Charlie Munger advocates that when you're buying shares in a business, you should treat the shares, no matter how small the number you are buying, as if you are buying the whole business. When you're looking at buying shares in a business, you need to start from the fundamentals when you begin your research, then work your way up. What does the company do? What do they sell? What service do they provide? What is the value the business generates for its customers? The key fundamental is that if you do not understand the business and what it does, you cannot understand the underlying assets of the business, and you cannot ascertain its true value to know if it's under or overvalued, and therefore whether you should invest or not. If you focus on the core value of the business you're looking at buying stock in, you do not need to consider short-term fluctuations and ripples in the economy, as the core of the business remains sound throughout any economic turmoil. Charlie Munger says that if you fail to do this ground-up research on the business for which you are buying stock in, then you are a speculator rather than an investor. If you are an investor, you are trying to determine the true value of the asset so that you can make the correct educated decision whether to invest or not. Speculating on a business is the lazy approach to investing in stocks and shares, and is merely a gamble on red or black. This does not take any skill, and 99.9% of speculators lose money in the stock market. You would probably have more luck throwing a dart at a dartboard to pick a stock if you are purely speculating and not doing the correct research. If you invest after doing true in-depth research, then your portfolio will be a lot more successful than any speculator's portfolio will ever be. The second lesson from The Complete Investor is to keep an eye on long-term opportunities. Remember, when buying the shares of a company, you are taking an ownership of that business. For long-term opportunities and gains, look for companies with good valuations and look to buy them at a discount. This strategy includes holding assets like bonds, stocks, exchange-traded funds, ETFs, mutual funds, and more. Individuals who take a long-term approach require discipline and patience. That's because investors must be able to take on a certain amount of risk while they wait for higher rewards down the road. It is advisable to hold stocks for the long term. The S&P 500 experienced losses in only 11 of the 47 years from 1975 to 2022, making returns volatile in the short term, but averaged out over the long term, investors who play the long game were rewarded with returns in the 10% range on average. Stocks should be considered to be long-term investments. This is, in part, because it's not unusual for stocks to drop 10% to 20% or more in value over a short period of time. Investors have the opportunity to ride out some of these highs and lows over a period of many years or even decades to generate a better long-term return. Looking back at stock market returns since the 1920s, individuals have rarely lost money investing in the S&P 500 for a 20-year time period. Even considering setbacks such as the Great Depression, Black Monday, the tech bubble, and the financial crisis, investors would have experienced gains had they made an investment in the S&P 500 and held it uninterrupted for 20 years. So always think long-term and do not try to time the markets. As we always say, it's time in the markets, not timing the market, which is the correct investment strategy. And while past results are no guarantee of future results, history does suggest that the markets favor the long-term players over the short-term market traders. The third lesson is the importance of consistent learning. Successful investors like Charlie Munger and Warren Buffett not only invest in stocks and shares, but they invest heavily in themselves. 80% of Charlie Munger's day is spent reading, absorbing as much financial information as possible, and he believes this is the key to his successful investing. Munger's successes as an investor stem from his desire to learn new things. He has a belief that successful investors are learning machines. And as you are still watching this video, it appears you also are a learning machine. It's people like you who watch my videos all the way through to the end, which allows me to keep delivering them to help you with your financial journey. A like or a subscribe would be most appreciated, as it does take a lot of work to produce these videos. If you have done that, then thanks again, and let's get back to the video. The next lesson from the book is to learn the traits of the value investor. There are 13 key traits which a value investor possesses. A value investor is someone who picks stocks that appear to be trading for less than their true value. And those traits are: 1. Patience. If you are investing in the financial markets, you will not get rich overnight. Think long-term and have the patience needed to stay in the investing game for the long term. 2. Disciplined. Be disciplined in your approach to investing. Make sure you do your research on the business you are buying stocks in. Don't be lazy and don't take the shortest path. Take the path which will give you the most confidence in knowing all you can about the business you are about to own part of. 3. Calm but courageous and decisive. You need to have a level head for investing and stay calm. The markets will rise and fall as they always do, but stay calm. Be courageous and decisive. If you have done the correct research into the business and you believe it is a buying opportunity, don't let the current economic or financial situation, good or bad, sway you from what you believe is a good investment. 4. Reasonably intelligent but not misled by a high IQ. You need to be of a reasonable intelligence so you can understand the fundamentals of a good business. But people with an IQ which is too high will look too far into the details of future scenarios, which may never happen. So don't over-evaluate. Stick to the fundamentals. 5. Honest. You need to be honest, not only with yourself but with those around you. Being honest is not only for investors but should be part of your character no matter what you do. 6. Confident and non-ideological. Things don't have to be perfect for you to enter an investment. You just need to be confident that you have done enough research for you to be comfortable with the risk. Doing in-depth research minimizes the risk. 7. Long-term orientated. Think in 10-year blocks in terms of investment milestones. Things don't happen overnight. Give them a chance to breathe. When you buy a stock, you should be of the opinion that you are going to hold that stock forever. 8. Passionate. You need to be passionate about what you are doing, or you won't last long in the investing game. Be passionate about learning and passionate about investing, and this will stand you in good stead for your investing journey. 9. Studious. Learn all you can, read all you can, watch as many videos on YouTube about investing as you can. Again, thanks for watching this video, and you will already have a huge head start on many who fail to do this. 10. Sound temperament. It is important to have a sound temperament when investing, so do not overreact to market situations, and keep your temperament under control. 11. Frugal. Be careful with your investment funds and only invest what you can afford to invest in the markets. Don't blindly buy into shares without doing your research because someone said it was a good investment. Always have your emergency fund on top of your investment funds for unplanned life expenses. 12. Risk averse. You should always aim to minimize the risk to your investments. While it is impossible to reduce risk to zero, it is important to de-risk any investment as much as possible by making sure you have taken all the steps we mentioned in this video before making any investment. If you like this video and would like to read Charlie Munger, The Complete Investor, there's a link in the description for you to get a hold of that book. If you like the video, please hit the like button and let me know in the comments below. Have a look at this next video to keep on building your financial knowledge, and please share this video with a friend who is interested in becoming financially free. I'll see you in the next one. Thanks for watching.